Let me start with a strange but important question. If your portfolio dropped 30% tomorrow, what would you do? Would you calmly continue investing? Or would you feel a quiet urge to reduce risk until things stabilize? Most people believe they would remain calm. But history suggests something different. In every major downturn, 2008, 2020, 2022, intelligent investors abandoned carefully designed portfolios at exactly the wrong moment. Not because they lack intelligence, but because they built portfolios they could not emotionally hold. And that is what this video is about. This is not about picking the best performing assets. It is about designing an allocation you can actually live with through calm markets and turbulent ones. Because the biggest risk to your portfolio is often not the market. It is your reaction to the market. Today I will show you 5 mistakes people make when designing portfolio allocations. Mistakes that quietly guarantee they will abandon the plan during the next downturn. And there is a good chance you have already made at least one of them. Let us begin. Mistake 1. Building for maximum return instead of maximum consistency. Many investors build portfolios that look perfect on paper. High equity exposure, minimal cash, no bonds, maximum expected return. The spreadsheet looks impressive, but spreadsheets assume perfect behavior. Real life does not. When markets fall 20 or 30%, something interesting happens. The same allocation that looked efficient suddenly feels aggressive. You start checking your portfolio more often. You start questioning the strategy. You start wondering whether you should reduce risk for now. But the allocation did not fail. Your emotional tolerance did. That distinction matters. A portfolio designed for maximum return often assumes you will behave perfectly during stress. But most people do not. A portfolio designed for maximum consistency assumes you are human. And human investors need something they can hold through discomfort. So when designing your allocation, ask a different question. Not, what produces the highest expected return? But, what can I calmly hold during a 30% drawdown? Because an allocation you can hold usually compounds better than one you abandon mid-cycle. Mistake 2. Ignoring your true time horizon. Many people say they are investing for the long term. But their life structure tells a different story. You might say you are investing for 20 years, but part of that money might be needed in 5. For a house deposit, a relocation, a career change, a family decision. When short-term needs mix with long-term capital, something dangerous happens. Volatility becomes stressful, and stress creates pressure to sell. The solution is simple but often overlooked. Divide your portfolio by time horizon, not just asset class. Money needed in 3 years should behave differently from money needed in 20. When timelines are clear, volatility becomes easier to tolerate, because you know which capital is truly long-term. Third mistake. Misunderstanding emotional risk tolerance. Risk tolerance is not how brave you feel when markets are rising. It is how calm you remain when they are falling. Behavioral research shows that losses feel twice as painful as equivalent gains feel good. Which means many investors discover their true risk tolerance only during drawdowns. You may believe you can tolerate a 30% drop, but when it happens, you may check your portfolio daily. Your sleep changes. Your focus changes. Your behavior changes. The solution is not pretending you are more tolerant than you are. The solution is alignment. A slightly less aggressive allocation that you hold consistently often outperforms a theoretically perfect allocation that you abandon during stress. Mistake 4. Adjusting allocation at emotional extremes. Markets influence mood. Rising markets create confidence. Falling markets create doubt. So many investors increase exposure after strong performance and reduce exposure after sharp declines. In other words, they buy high and sell low. Not intentionally, but emotionally. The solution is simple discipline. Define allocation bands in advance. Rebalance on a schedule. Avoid structural changes immediately after dramatic headlines. Markets move in cycles, but disciplined systems often outperform reactive ones. The most overlooked factor. Now we arrive at something many people miss completely. Your life structure influences your portfolio behavior more than your portfolio itself. If your life has low financial margin, your allocation will feel riskier than it actually is. High fixed expenses, thin liquidity, unstable income. These conditions turn normal market volatility into emotional pressure. And when pressure rises, portfolios become difficult to hold. So the final principle is simple. Strengthen life margin. Liquidity. Flexibility. Reduced fixed pressure. When life becomes structurally stronger, portfolios suddenly feel easier to hold, without changing the allocation at all. The core principle is this. If you want to build an allocation you can emotionally hold, you are not optimizing for impressiveness. You are optimizing for durability. Let us summarize clearly. Build for consistency, not theoretical perfection. Align with your real-time horizon. Respect your emotional tolerance. Avoid adjusting allocation during emotional peaks. Strengthen life margin so your portfolio is not carrying survival pressure. Wealth compounds best when behavior remains steady. If this idea resonated, comment durable. It signals that you are building for stability rather than drama. And if you value calm, structured thinking about investing in volatile times, subscribe. In the next video, we will explore how to design contribution systems that remove market timing entirely. I will see you there.